Australia has a big promise, a bold one actually. The government's talking about cutting emissions by 70% within the next decade. 70%. And yet in the last 20 years, we've barely moved the needle. So how do we square that circle? Because here's what's actually happening behind the scenes. The companies that were supposed to build this green future, they're pulling the plug. Billions of dollars in projects gone. And the money stepping in to replace them isn't private money. It's yours. It's taxpayer money. And that there tells you everything you need to know. My name is Richard and welcome to Ronc Industries, the industry blog for investors where we're pro-wealth, pro-growth and pro-energy. And we're going to be looking at why private equity is backing away from renewable energy projects. So let's start with what's already fallen over. Across Australia, green hydrogen projects have been cancelled or they're stalling at a pace that should be making headlines. We're talking about projects valued anywhere from $207 million all the way up to $12.5 billion, gone, and all within around about a 6 to 12 month period. And the reasons given? Lack of demand, unresolved engineering challenges, input costs that don't stack up, and the big one here is a lack of cheap power. And the last point is worth sitting with. Green hydrogen requires enormous amounts of electricity to produce. It's an energy-intensive process by definition. So if you can't generate enough cheap energy, reliable electricity, you can't make green hydrogen work. It's a circular problem and industry knows it. The other reason being whispered, and it's almost refreshingly honest, is that companies are waiting for a government subsidy before they'll commit. Now let that sink in. Now, in October 2025, I attended the Australian All Energy Trade Show here in Melbourne. And what I saw and what I didn't see was incredibly revealing. Now, in my personal opinion, more than 90% of the stands were one of three things. Firstly, they were either solar panels, batteries, either lithium or sodium, or EV charging stations. And that was it. That was the show. No wind, none. Which honestly, I found quite striking. And when it came to solar, something really did catch my eye. These panels weren't being marketed with round numbers such as 470 watts or 460 watts, not 22 or 24% efficiency. The numbers were hyper-specific: 463 watts, 465 watts, 22.8% or 23.6% efficiency. Now, why does all the numbers matter? Because when an industry is competing at the level of single watts and decimal points of efficiency, this is a sign that it's a mature industry. The technology is largely settled. You're not seeing moonshot innovation. You're seeing companies fighting over scraps of marginal gains. And here's what wasn't at the show. No emerging clean tech, no nuclear industry presence, no oil and gas, no crackpot moonshots. Which, for the record, is exactly when you want to see crackpot moonshots. If the energy transition is the challenge of our generation, where's the ambition? What you didn't see at the trade show might have mattered more than what you did. Now let's talk about Fortescue, because this is where things get genuinely puzzling. Fortescue under Andrew Forrest has gone all in on renewables. Net zero by a certain date, green hydrogen as the future of mining, the full vision, the works. Big ambition. And I've got serious respect for the swing. But here's the scorecard so far. The Gladstone Green Hydrogen Project has failed. The Gibson Island Hydrogen and Ammonia Project shelved. And Fortescue reportedly still owes the Queensland state government $110 million in public funds from the Gladstone project. Now, despite that outstanding debt to taxpayers, the federal government, through the ARENA program, the Australian Renewable Energy Agency, has just handed Fortescue another $45 million for a solar innovation hub in Western Australia. So the question I keep asking is, why? Fortescue has a market cap of roughly 62 billion Australian dollars. Their after-tax net profit in financial year 2025 was about 5.2 billion. Now, yes, that's down from 7.2 billion 2 years prior, but we're not talking about a company exactly that's on its knees here. A $45 million loan at 7% interest over 10 years, that's, let's say, about $520,000 a month in repayments. Now, for a company generating billions in profit, I'm being a bit facetious when I say that's probably a little bit of a rounding error. But why is Fortescue taking public money for this? And why is the government handing it over? If the business case for this solar hub genuinely stacks up, if the return on investment is real, then private money should be lining up to go into the project. Venture capital, joint ventures, a straightforward business loan. That's how it's supposed to work. But private money doesn't seem to be lining up. And this is the point. Now, here's the uncomfortable truth that this whole picture is pointing toward. Private money is typically seen as smart. Venture capital, institutional investors, major banks, these entities exist to make money. They exist to make profit. They take risks, yes, but they take calculated risks. They're investors. And right now, they're moving away from large-scale green hydrogen, green ammonia, and certain renewable energy projects in Australia. Meanwhile, the government money, public money, your money, keeps flowing in. Now, there's a principle worth stating plainly here. In a functioning market, capital converges on the best solution. The technology that genuinely works attracts investment, then it scales up and eventually it dominates its market. The technology that doesn't work gets starved of capital, lingers on the margin, and maybe perhaps survives only as a niche, or it could end up disappearing entirely. What we're seeing with parts of the renewable sector, particularly hydrogen, looks like the second scenario. Projects are failing, private money is retreating, and the only funding keeping certain projects alive is public money.
Government has to fork out lots of our money to try to get lots more investment in green energy.
When a technology needs a convoluted government subsidy scheme such as the Capacity Investment Scheme, or CIS, just to get off the ground, that's not a sign of a technology on the verge of a breakthrough. That's a sign of a technology that doesn't yet work at commercial scale.
Now, obviously, we're very keen to know how much that is costing us. And you asked that question in Parliament today.
Can the Treasurer please inform the House of the cost to the Commonwealth budget on a 25-26 year of the Commonwealth's capacity investment schemes, and to assist the Treasurer, I believe that they should be noted within the quantified contingent liabilities.
Thank you, Mr Speaker. As the member for New England should know, that because the capacity investment scheme involves a number of negotiations, then those numbers are not typically published.
And the market has already figured that out. So Fortescue's latest bet is a solar innovation hub after hydrogen failed and after ammonia stalled out. And the pitch is to trial emerging technologies to reduce the cost of renewable energy generation. So what does that mean in practice? Well, from what's been floated, robotic installation systems, automated construction, the kind of efficiency gains you'd expect from smarter logistics, not from a fundamental leap in the technology itself. But here's the problem. Solar panel efficiency has been sitting in the 22 to 24% range for commercial products for years. Now, yes, there are lab breakthroughs that are announced periodically, but the market-ready product has been largely steady. And as I pointed out earlier, companies are now competing at fractions of a percent. That's not revolution, that's incremental. A few unmanned systems shaving costs of installation doesn't change the fundamental economics over a 15 to 25-year asset lifecycle. And it certainly doesn't change the fact that 99% of solar panels used in Australia are actually imported. There's no domestic manufacturing industry, no industrial scale private investment building up that capability. If solar is truly central to Australia's energy future, why isn't private money building the manufacturing base to support it? It's not like we're going to be short of demand anytime soon. So here's where I land on all of this. Australia's renewable energy story isn't being told by the trade shows or the government announcements. It's not even being told by the press releases from mining billionaires. It's being told by the absence of things. The absence of private capital in large-scale projects, the absence of domestic manufacturing, the absence of competing technologies being seriously developed, the absence of venture capital money willing to back the next generation of clean energy at scale. What you don't see is always more honest than what you do. Political targets that would transform or potentially cripple heavy industry, private money heading for the exits, a multi-billion-dollar company taking public funds for projects that the market won't back. These are signals, and they're all pointing in the same direction. ARENA may be one of the last places where funding for some of these projects actually exists. And if that's true, it raises the hardest question of all. Is this a genuine energy transition, or is it a very expensive exercise in hope? I'll let you decide. Thanks for watching. I'll see you in the next one.